Hey, it's Jake here, founder and developer of MogulTool. I'm excited to announce the new version of MogulTool for multifamily version 5.0 and to show you some of the new features and what you can expect from the model moving forward. I've included a sample scenario to kind of help walk through. So I'll just get straight into it. The model that the scenario we're going to be talking about today is a 24-unit property. 1.44 million asking price, about $60,000 a unit. It's a six cap market. It's a 7.11 cap based on the broker's numbers, and then a 3.67 on the true numbers. And then just for the sake of the scenario, we'll just say that you've confirmed all of your renovation and operating assumptions for the model. So to show you how confident I am that the new model is the simplest and best version yet, I've actually hidden the top bar just for the sake of simplicity. But you can obviously just open it up and pin it if you still want to work with it up, which I recommend. But just for the video, we're just going to hide it and show you how much you can do without having to use any of the kind of embedded formulas and tools that Excel has. We're going to keep things nice and simple. So just in our property information box, just go ahead and put in all the information. I put in the 1.44, 24 units, $60,000 a door. As you can see, we have some updated buttons. I'll talk about those in just a second. But the buttons make it super easy to kind of flick back and forth between the numbers that you have. We also have a syndication model now. So if you're not going to be purchasing this property with your own cash, then and you're going to be working with partners, then you can put in your limited partner equity in here, as well as your asset management fee and preferred return. If there's going to be an acquisition fee, you can input that in the sources and uses tab in the acquisition fee section right here. But for this scenario, we're just going to model a 75-25 split with a 2.5% asset management fee. We know that we're going to have a conventional loan on the property. We'll just model 75% down, or 75% loan to value for now at a 4% rate, no interest only. And again, we know that this is a 6-cap market, and I could talk a little bit more about why I have the the disposition, the sale cap rate at a 6.5 versus a 6 cap. But what we're going to say is for the video, we're going to choose a 7-year hold with a 6.5 cap sale valuation basis. So it has a number right here. I'll show you how that number is calculated. But now we're going to move over into the financial analysis tab, and then we'll come back to the dashboard in a minute to talk about what you're looking at. So the current numbers, let's just say you went through and you did a quick once over of maybe the broker put together a package and it had all of the current information in it, or you had the raw documents in Adobe Acrobat or something, and you just went through and looked at it yourself. So this is what you came up with. Let's just say that the 24 units were renting for $600 a month per unit, and I don't know, maybe there was some vacancy, maybe not. I'm not going to include any for now, but let's just say $600 a month per unit. That generates $172,000 for them, and then maybe they're operating at $5,000 a year per unit in expenses. Again, I don't have everything filled out because this isn't a real scenario. Normally you'd have a bunch of different numbers right here which would add up to 5,000, but I'm just going to put in 5,000 times 24 units right here, and that generates an NOI of $52,800. Now obviously at a $1.44 million purchase, $52,000, that's a pretty expensive deal. So we'll keep that in the back of our minds. I'm also going to put in that maybe the broker said that this property can not only can it run better than 600, it can run at 725 a unit per month. And hey, I'll even throw in some vacancy there. In this case, I chose 5% because typically you're going to see maybe some more aggressive numbers on a broker's package. And then not only can it operate at a higher income, but it also is going to operate instead of at $5,000 per unit per year, it's going to operate at $4,000 per unit per year. So not only a higher income, but a lower expense ratio, so your NOI is going to double. And this is not uncommon for you to see such a kind of significant increase in the NOI. between the true operations and what the broker is saying the deal can come at. And when you look at this number versus the $1.44 million purchase price, it actually looks like kind of a pretty, looks like a good deal, because if it's a 6-cap market and he's saying that this is how much the property could generate, hey, we could sell this property for 1.7. It's almost like, hey, you're lucky we're selling it for 1.4. And what they're doing is they're baking in some of the upside, the renovation, that rent increase into the price, because if they were selling it at a true 6-cap, they would sell it for $880. So the fact that they're capturing some of that extra value that you would get from raising the rents in the purchase is shown in their $1.4 million asking. But you know that you're not going to be able to get there in the first year. And maybe you can get there. In fact, there's a good chance that you can get to these numbers down the road, but it doesn't make sense to give up the value of it on the purchase. So what you would do is you would take those numbers, you would use those numbers, and you would kind of find your version of the truth somewhere in the middle. So the next step, which is new from the old Mogul tools to the new ones, is now there's a rent scheduling tab. It used to be kind of cluttered and busy down on the bottom. Now there's a whole tab just for it. And to kind of quickly walk through this, what I'll do is I'll show that every single, you can take, essentially the rent roll, and you can organize it into this rent roll analysis tab, which is very easy to do. But let's just say, for the sake of simplicity, again, all the bedroom or all the unit mix is 2-bedroom, 1 bath. Okay, so we'll say they're 1,000 square feet per unit. There's 24 units total. Right, they're at $600 a unit currently, it comes out to $172.8, which matches what the income is from the current operations. So we know that that's a good number. And then we think that we can generate $725. That's our target. So we have $125 in premiums, which comes out to $36,000 a year. Now, if we are going to renovate the property, then obviously there's going to be a certain duration of turn time when the property is being renovated, where nobody's inside the unit. And so maybe it only takes 2 weeks to renovate the unit, but then you have to wait for another 2 weeks for it to be leased out, right? So whatever the duration is that you select, for this scenario, I'm just gonna model it. We're gonna turn 1 unit every month. So every 4 weeks, we're gonna turn 1 unit, and we're gonna turn all of the units over the course of in 2 years, right? That's how long it's going to take for the property to be renovated and completely stabilized. And then anything that's not being renovated is we're just going to assume 4 weeks of vacancy, 1 month of vacancy a year. So the spreadsheet is going to automatically calculate what your vacancy rates are going to be. It'll feed in the rent premiums based off of how many units you complete each year, which is based off the information that you put in right here. And then what it'll do is it'll automatically put this blended annual vacancy in to your pro forma. And year over year, it'll automatically calculate what your vacancy can be. Now, you can overwrite this yourself, but this is a pretty accurate way this is the most accurate way of identifying what your vacancy is going to look like year over year. So let's say that you've taken these numbers. This is $172.8. This is that number, that's $600 a month that it's currently operating at. This is the first year's amount of the premiums that have been phased in, and it automatically populates the vacancy from that first year. And then maybe you think you can run it better than $5,000 a unit per year, but maybe not $4,000. So somewhere in the middle, let's call it $4,500. And your property manager said this looks good. So your NOI that you came up with is $68,000, which is higher than the current, which is good, because obviously you wouldn't buy the property if you didn't think you could manage it better than they're currently operating it. But it's much lower than the broker's numbers, which makes sense, because the broker's numbers are going to be usually a stretched version of the truth. Okay, so now we've handled our offer model, and as you can see, there's a tan column right here. If we wanted to do a sensitivity analysis, which I'll cover in another video, you could turn a sensitivity analysis on, weight the potential outcome, and then change the variation. What this will do is it'll impact the cap rate that you refinance or sell at. It'll impact how properly the deal, or how closely the deal performs to your target numbers, and it makes it so that you can have all of it in one spreadsheet versus having two versions of the same spreadsheet. And then when you make a change on one, you have to make it on the other, right? So this just keeps everything on one spreadsheet nice and clean. So we've taken care of the income, we've taken care of the expenses. Now we need to look at our closing costs and our CapEx, which I've just gone ahead and filled out, $5,000 a unit for 24 units. That comes out to $120,000 in CapEx. And then I've also put in a $25,000 operational reserve with some additional closing costs. It comes out to basically $40,000 in closing costs and reserves, plus $132,000 in CapEx. And that extra little bit comes from a GC factored in. We can just take that out, and so there's that 120 right here, plus $40,000 in closing costs. The total project uses are going to be 1.6, call it 1.6, and then our debt and equity comes out over here, and you can kind of see the breakdown of it. So we've basically put in all of our inputs. Now we can go back to the dashboard and see how we're looking. So if you go to the return summary tab, this is showing you how at the current, using these current settings, all of these different inputs that you've put in, what this deal will return at a certain purchase price. Now, as you can see, this is kind of, actually it depends on what your own personal investing criteria are, but this is usually going to be below, 11 or 12% IRR is going to be below a typical investor's return criteria. So what you can do now to start kind of honing in on the number is use these action buttons below to kind of fine tune the number that you like. So let's say, these are the return hurdles that your investors have given you. They want at least a 16% internal rate of return. They want to see a minimum 24% average annual return, and that includes your proceeds from a liquidity event, so in this case, the sale in year 7, or the average cash on cash return of 8%, right? And so what you can do is you can use these buttons to update based off these different hurdles. So let's say we wanted to look at the average cash on cash, and we want to figure out what purchase price is going to give us an 8% cash on cash return a year based on these other conditions. So I set 8% in, I'll click the average cash on cash, it updates to the maximum offer price that we can offer. In this case, it's 1.07. Maybe I want to see the IRR, 1.06. Average annual return, 975. So what it's starting to see is that, let's go back to the cash on cash, right? So right now we're on the average annual return. That's 975, and that's $40,000 a door. If we go to the cash on cash, that 8%, that's 44. So we know it's going to be somewhere between 40 and 44 is going to give us our target returns based on all the other stuff. So let's just go ahead and set 40. Let's just go ahead and set 40,000 in the target price per unit. We will update so that we get a nice clean number, and it's 960. Now, even still, this purchase cap rate, which is based off of the T12, we might be overpaying for the property, at least on paper, but we've sharpened up our pencils. We know that we feel comfortable with how we can operate this property, and we've kind of quickly come to the number of 960. And let's just say that the broker said, hey, I got a motivated seller, this is the number I came up with, based off of what we think the property can put together. In this case, here's this, their big NOI. He's like, hey, I got to price the thing, at a competitive rate. So that's how we picked 1.4, but if you come in with a reason at a, good price, hey, if it just says throw me an offer, this is how you would do that. This is how you would go in and, adhering to your own criteria, be able to come up with a number that you can, kind of stand behind and explain to the broker how you arrived at it. So anyways, as you can see, there's a lot of different features in the spreadsheet. A couple of features that we didn't talk about that, can kind of help is, in this case right here, maybe you're let's say we want to put in a refinance. And, let's say your property manager is saying, hey, yeah, they want, $60,000 a door. So maybe we have to give them that $60,000 a door. But that's in its current, thing. When we renovate this place and, kind of fix it up, let's say a year from now, let's say a year from now, we can sell it for, 1.44. We could even, I think for sure we could sell, there's even comps that show we could probably sell it for 1.6. So let's go to 1.6. With that's our target refinance valuation. We can update the actual refinance cap that we would need to hit to hit for 1.6. In this case, it's 4.26, and hey, maybe that seems like a low number, but if the again, that's based off of the NOI at year one, at the end of the year one, and maybe this seems like a low number, but maybe the property manager knows something that you don't, or this is just kind of one of those things. So you can use this number right here to kind of fine tune the target cap rate that you want to hit. Maybe you don't hit it year one, maybe you hit it year two. Well, if you hit it year two, then all you need to do is, now it makes it a more reasonable number, 5.55 cap, and maybe a bank would lend to that. So anyways, that's one way that you can go ahead and, use these updated buttons. I encourage you to kind of click around and see, how things work and kind of the best way to work through everything. But version 5.0 is a much more powerful version than the other ones. And I'm excited to share with you this updated version. If you have any, a lot of these updates came from people making requests at what they'd like to see. So if you do have any additional requests, please let me know. As usual, most of the sales that I've made have been through people referring the spreadsheet to people that they work with. And so if you think that this spreadsheet would have value to your partners or anyone that you're working with, please recommend it. I would certainly appreciate it. I'm actually in the process of setting up a referral program to make it a little bit more, give you a little bit more incentive to kind of send it out and refer it. But, I hope that this adds value. And if you have any questions or comments, please reach out to me. My email is right here, support@mogultool.com, or you can reach out to me on either Facebook or LinkedIn. So thanks for tuning in, watching the video, and I'll hopefully talk to some of you guys soon. Take care.